Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts.
Okay, this is just, it doesn't matter what time frame you're looking at. You can look at a 15, you can look at a 5, you can look at a daily, regardless, okay? We had a weak Dow. Weak Dow means risk aversion. Now, remember I said earlier, I try to take advantage of the movement in the dollar-yen to give me an idea of what's the driver behind psychology. Well, obviously, risk aversion and a sell-off in the equities market is what drove the market in terms of why people were doing what they're doing. Why were they rallying the dollar? Why were they rallying gold? To me, the root cause was this weakness in the Dow. When I have weakness in the Dow, if it is the market driver, what I'm going to see is the dollar-yen is going to be tracking with it. Now, obviously, I showed you that 60-minute chart of the dollar index moving up higher. Okay? The dollar-yen can sometimes move with the dollar index, directionally speaking. It can sometimes directionally move with the dollar index. And when it does, that tells me the dollar is the driver behind the psychology. So again, today, the dollar-yen is telling me that the Dow is, the equities market is. So I see this market moving lower with equities. Once I make that determination, that the dollar-yen is moving down with equities, and by the way, I use the Dow Industrials, not the S&P 500. It might sound funny that I use the Dow, but from a psychological perspective, if I want to see what the opinion of the equities market is, if you go hit the streets right now and talk to anybody you know in your neighborhood or your favorite restaurant, whatever, most of them will probably tell you where the Dow is. I'd say very few of them have any clue as to where the S&P is. Okay? Even though the S&P is an index of 500 stocks and probably a much more comprehensive look at the overall market, the Dow is still the most psychologically relevant, which is why when I'm trying to understand what the mood is on Wall Street, I'm going to find myself looking at the Dow Industrials. So let's go back to this YUK and what my setups would be here. Now, obviously, we're looking for weakness. But for me, it's not enough to say, okay, I've got a weak market, okay, I want to buy puts. That's not enough for me. Because one of the things that I've talked about here when I've spoke at the ISE is an option is really what I think, a three-dimensional thing. There's three aspects to it. This is both what makes them slightly complicated to a new options trader, but what makes them so powerful once you understand how to harness these three forces. Okay? And the three forces are this. I'm looking at an option. What I always want to keep in mind, okay, is that I've got this aspect of time. I've got this aspect of, well, you can call it location or price, where you've situated your where the strike you own, okay? And then finally, I think what you're really being able to take advantage of is volatility. Okay, so this is what I always keep in mind when I'm trading options. I have to have an understanding of time. How much time am I going to give myself for this option to reach or get close to my strike price being item number 2. Where am I located on the chart? What's my price? What's that strike that I bought? Whether it be a put or call. And finally, volatility. Now, volatility is really, to me, the gem of an option. Okay? I don't want to pay for it. I do want to be able to benefit from it. I do want to profit from it. Again, I don't want to pay for it. I want to profit from it. So that's why we took so much time talking about what the specific volatility, what the kind of pip movement ranges we'll see on our ISE options often are. And that's why I'll make sure I put that image on my blog at RagheeHorner.com so you can check that out. Because understanding what the typical volatility is in those markets, I think is absolutely paramount to making sure you're able to, I think, benefit from the real value of options. There's always a way to take advantage of the market with options. I may have one particular strategy. If you take a look at the archives here at the ISC, you'll probably find another 20. You find the ones that you, number one, can understand, okay? And you try to find ones that will take advantage of different market cycles. Let's talk about market cycles for a moment, okay? Because to me, this is really another aspect that's related to the volatility. Okay? And this comes straight from Charles Dow. And you think about Dow theory, and I think probably one of the most popular tenets of Dow theory is this idea of market trends. And this was Charles Dow explaining that the market psychology, the external psychology of the market can be tracked and described by three phases that he spoke of. He called them the market trends. Accumulation. I'll go ahead and put this on the screen here. So we're talking about Dow theory. We're talking about market trends. So he talked about accumulation, markup, which we know as uptrends, and distribution. Accumulation is a sideways, narrow-ranging, low volatility cycle. In other words, prices are moving sideways. They're usually in some sort of channel. For those of you that like to trade chart patterns, you might be seeing a rectangle or a triangle on your charts. Okay? So it's sideways, it's narrow-ranging, it's quiet. Sometimes there's low volume accompanied with that. Now remember, Charles Dow was talking about stocks when he described these, so obviously there was a bullish bias behind it. We don't have that problem with our FX options. I could just as easily buy a put as I could a call, take advantage of bullish or bearish sentiment. But he had a markup cycle, which is what we know as an uptrend. Most people also include a markdown, which is a downtrend. And finally, distribution. Distribution is a cousin to accumulation, but what it is also a sideways market cycle, but it's wider ranging. It has more volatility. So while accumulation and distribution are both sideways markets, distribution is wider with more volatility.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.